need confirmation. So here is the formula. You first need to find key dynamic support and resistance areas. Once price gets to these areas of dynamic SR, you need confirmation, meaning you need price action telling you that price is indeed reacting to these areas. And 3, you need a key strategy. This is the most important thing. In our strategies, we reveal to you the secrets to how to know when price is truly reacting and is ready to change directions. And once all these 3 parts are satisfied, that is when you have a trade entry. So in the last episode, we showed you the first key, which was using the higher time frames, being the monthly and weekly, to find key support and resistance points. Now, in this episode, we are giving you another key, which is called time frame confluence, meaning every time frame should be telling you the same thing. So let's jump right into an example. Here's the pound yen. Here on the weekly time frame, we have a clear level of resistance. Now, from looking left, we can clearly notice an area where price has reversed from drastically. So when price comes up to this level, we notice a long wick doji, which is a bearish signal. So when price comes up to this level again here, we have 2 small hanging candles, which is also a bearish setup. So on the weekly time frame, this is bearish price action. Now, you want to see bearish price action on the daily as well, so that the time frames are lining up. Now let's jump down to the daily. So here in the daily, we need to confirm our bearish bias, meaning we need bearish price action again. Now, notice how when price gets to these areas, it breaks the trend line, which is bearish price action, and confirms the weekly bearish bias. And now you have both weekly and daily bearish price action. So now, going from the opposite direction on the pound yen. Here on the weekly time frame, we have a clear level of support. Now, from looking left, we clearly notice an area where price has reversed from drastically. So when price comes to this level here, we notice a long wick candle at this level, which is bullish. And again, when it came up a second time, another long wick candle, which is again bullish. So the weekly time frame shows bullish price action at both these points. You again want to confirm this bullish bias on the daily time frame, so that the time frames are all saying the same thing and are confluent. So again, on the daily time frame at this level, there is a confirmation of bullish price action through the break of the trend line at both points, giving you both bullish price action on the daily and the weekly. So here's an example of when timeframes do not line up, meaning when 2 timeframes are telling you different things. We again have the pound yen here. Now, this was a trade that a lot of people got faked out by and took it short, which resulted as a loss. From the naked eye, this would have looked like an amazing trade. As you can see, price broke through support, pulled back, rejected this new resistance, as well as the 50 EMA, and creating 2 very nice long wick candles. Most people would have taken this short, as it looked like an A+ trade. This is where beginners make their biggest mistakes. Now, here's the thing. The time frames are telling you 2 different things. From the weekly time frame, you have a short bias. But now, look what happens when we jump down to the daily. Here on the daily time frame, price just broke this downtrend and is making higher highs and higher lows, which is bullish. This is bullish price action. We're in a bullish market. The weekly is showing you a downtrend and a bearish market, but the daily is showing you clear bullish price action. See how the time frames don't line up? This trade was a killer because it trapped a lot of beginner traders short, when in reality the trade was actually going long. This is the importance of time frame confluence.